But the question for many is what happens in the longer term for us if they add negative interest rates into their toolbox? Hello everyone, this is Ronan Blue, and today's topic would be on Japan and its negative interest rates. Is this also our future in North America as well? Back in the day, to battle the global financial crisis by the collapse of the Lehman Brothers in 2008, many central banks made a decision to cut interest rates to near zero, and history is repeating itself again since this recent pandemic. After 2008, a decade later, interest rates still remain low in most countries, especially in Japan. Japan has had negative interest rates for 4 years now, where in February 2016, the Bank of Japan cut the interest rate from 0.1% to negative 0.1%, even after having had ultra-low interest rates for more than 2 decades since the financial crash in the 1990s. Japan actually resorted to policy measures, including a negative rate policy following the Euro area, Switzerland, Denmark, and Sweden. That also allowed rates to fall slightly below zero that fit best for those countries with ultra-low inflation or deflation, where falling prices is associated with weak economic growth. They are today actually thinking of cutting the rates even further, and these interest rate cuts may actually do more harm than good to Japan's economy, hit by a fallout from the coronavirus pandemic, where the IMF warned the central banking system against pushing rates deeper into negative territory. But the reason why Japan decided to go negative rates in the first place was to try and fight a persistent slump that took hold after the collapse of a vast real estate and stock market bubble in the 1990s. The lower interest rates were meant to encourage investments by companies and push up inflation, two goals the country wanted with the persistent falling of prices and wages. But how would negative interest rates affect you directly? Even if negative interest rates remains a very distant possibility, according to the US Federal Reserve, it's always good to understand how monetary policy can affect your personal finances. Negative interest rates would change a variety of your personal finance aspects, and here's how. Loans. While negative interest rates sounds incredible, some analysts warn that extremely low rates on mortgages could drive up housing prices, since borrowing would become cheaper and thus skyrocket demand. Credit cards. Negative interest rates would depress credit card interest rates, but it's totally unrealistic for anyone to expect to get paid every time they swipe their credit card because it's negative. Savings accounts and products. Yields on savings accounts would be crushed by negative interest rates. One of the main functions of negative interest rates are to encourage spending instead of keeping money tucked away in an account. High-yielding savings accounts could become a distant memory. Big savers could be hit hard by negative interest rates. Depositors would pay money to save their money, a reversal of the normal rules of economics. So many would choose to hold physical cash instead. It's like having a whole banana when you deposit, but a year later, you only have 3/4 of a banana left over. The concept of negative interest rate in itself runs counter to common sense. Why would you give someone your money only to get less back at a later date? The central banks would actually charge a fee to banks, hoping to encourage banks to put their money to more productive use, lending it to households and businesses. Negative rates are supposed to then ripple through economies by lowering the cost of borrowing for everyone, something that should, in theory, encourage economic growth. So what are some of the pros and cons of this? Aside from lowering borrowing costs, it also helps in weakening a country's currency rate by making it less attractive investment than that of other currencies. A weaker currency gives a country's export a competitive advantage and boosts inflation by pushing up import costs. But Japan's central bank is currently reviewing its economic policies, asking why they have failed to kickstart growth. The critics of negative rates argue that the policy discourages financial institutions from boosting lending as it hurts their margins, running counter to government efforts to provide funds to cash-strapped firms. The super low interest rates makes it difficult for banks to earn a profit through the traditional spread between depositing and interest rates and lending rates. Analysts have found that with such low margins, banks have largely ignored the central bank and governments to go out and lend more, especially to small startups that are seen as vital to the long-term health of the economy. For these entrepreneurs, the idea of cheap loans is a mirage because banks have largely decided to avoid the risks involved at any price. The Bank of Japan is only looking to lift consumer prices, which have been sliding for most of the past 20 years. And this is to fight deflation and the falling consumer prices that hurt corporate revenues, keeping companies from raising wages and spending on new projects. But the bank's efforts show that it's not working, and its main tool has been an extensive bond buying program, similar to what the Federal Reserve of the United States and the European central banks are doing. The bond buying injects money into the country's financial system. From there, it's supposed to flow to the rest of the economy. Now, it did work for a while, but recently the effect has faded. Prices are falling again, going further into deflation. So the question becomes, are negative rates working? The point to make here was that money was already cheap in Japan from 20 years ago, and by adding negative rates have only succeeded in making it even cheaper. The yield on the 10-year government bonds actually fell below zero, of course fluctuating, meaning investors are lending the government's money knowing that they will probably not be repaid in full. But looking at Japan's growth rate over the last 2 decades shows no real evidence of growth, showing the decisions made by the BOJ's negative rate monetary policy was not effective. Cheap money does not spur business expansion, and it doesn't foster economic activity either. Now, deflation is still there. Core consumer prices continue to fall with no explosion of new bank lending, as businesses say they can't find enough profitable uses for funding, even if the money is cheap. So what they do is they increase their dividend paying stocks because their money invested does nothing for investing into new projects because there's no growth. So there's been an increase in buybacks to prop up their company shares distributions of dividends to shareholders on a monthly, quarterly, and yearly basis. The deflation itself undermines the effectiveness of negative rates. If corporate revenues are shrinking because of falling prices, companies will find that even the most generous loan becomes harder to repay. Many potential borrowers are still telling bankers, no thanks, keep your money. But are people happy that money is cheap? Well, definitely not the bankers. Between the new fees they are paying the central banks and a general decline in lending income, profits at commercial banks are being squeezed by negative rates. So how would this all affect our side of the world? Well, US President Donald Trump believes that the United States should have the lowest interest rates in the world and would be a benefit to manufacturers, especially to US exporters, because lower rates would put downward pressure on the dollar, making American goods less expensive abroad. But it would also spark a race to the bottom as the United States tries to compete with negative rates in Japan and Europe. But looking at the economic situation as it is now, Trump may get his wish, as the US economy may be one recession away from a turn to negative rates. But the caution is it's a very different world when everyone's stuck at zero interest rates. It may add strange new economic risks in its own force of gravity that I have shown is evident in Japan, where negative rates have become the norm. Now, Japan offers the clearest preview of an economic fantasy world that the West may soon enter, whether it wants to or not. But of course, it's not just Japan. The European Central Bank, after taking a stab at negative rates in 2014, has now aggressively gone back to the policy. So why does Trump want to join Japan and Europe in this strange world? He has shown a concern with the value of the dollar, which he believes is too high. But it's been shown that in this past year, the central banks have shown they are willing to bail out anyone and everyone. But the question for many is, what happens in the longer term for us if they add negative interest rates into their toolbox? But it kind of looks like the world has gone mad and the system is broken, a danger of too much money now chasing too few opportunities. You can see that a surplus in capital is being pushed into questionable investments, both in bonds and stocks. At the same time, central banks will not be able to keep buying the debt forever and may need to pull back just as the economy slows, sending interest rates suddenly higher and stocks and bonds lower. And looking at Japan, the negative interest rates have left the BOJ without the ability to initiate a rate increase cycle. So there have been no improvements in the Japanese economy in the past 25 years that has given reason for rises in the interest rates. But once the zero rates infiltrate our economy here in North America, they become impossible to eliminate without an extraordinary effort which the Bank of Japan and Japanese political leadership have never been able to figure out. In economic downturns, people typically hold their money and wait to see some sort of improvement before they ramp up spending again. As a result, deflation can become very much a part of our economy. People stop spending, demand declines, price for goods and services fall, and people wait for even lower prices before spending. Negative interest rates fights deflation by making it costly to hold on to your money, to push you to spend. Negative interest rates makes it less attractive to keep cash in a bank. Instead of earning interest on savings, depositors could be charged a holding fee by the bank. And negative interest rates would make it more appealing to borrow money since it would push loan rates to rocket bottom lows. So are negative interest rates coming to the United States? As of now, the Fed remains against implementing negative rates as a tool to help stabilize the US economy. But some are saying that the actors in place have already priced it in and are creating a play of sorts and making it look like it's not coming when in fact it's already priced in and it's probably going to be coming in our near future. But implementing negative interest rates wouldn't be an easy task and may not be the best way to help our economy either. But overall, negative interest rates are a monetary policy tool that could be debated in what we need in these economic times, and some argue they require regulations to make them work. And although the Federal Reserve has repeatedly said it's not going to implement them at this time, having a general idea of how negative interest rates could potentially affect you in the future is worth understanding. Well, tell me if you think that we here in North America will be following Japan into the negative interest rate world in the comment section below, and tell me what you would do in that situation. If you like this vlog, please don't forget to give me a like, subscribe if you haven't already, and hit that notification bell for more of my coming content here. Thank you for watching my vlog. Be free, gain wealth, and travel far.